Here with us through the full hour for their analysis are our featured guests who are tapped into the needs and concerns of Bay Street in Calgary is Rona Ambrose, Deputy Chair TD Securities and former interim leader of the Federal Conservative Party. And in studio here joining us is Goldy Hyder, President and CEO of the Business Council of Canada. But before we get to the panel, in fact, I think we want to bring our own John Ehrlichman in to bring us the details of what's coming over the wires at this point. Shall we head to John for the latest?
All right. Yeah, Jacqueline, let's get to it because the deficit for this fiscal year is slightly lower than what was expected in the March budget. It's coming in at around $40 billion. The expectation, if you go back to March, was for a $40.1 billion budget or deficit. Now, obviously, coming into today, there were a lot of questions around the fact that we're in a higher interest rate environment right now and how that would potentially add to the deficit picture. Projected shortfalls over the next 4 fiscal years, however, are all higher. A $14 billion gap was projected for 2027, 2028. Now it's expected to be $23.8 billion, falling to $18.4 billion the following fiscal year. So that's one of the initial takeaways, is that challenge in returning to a balanced budget, and there doesn't appear to be a plan to do so right now, given those projected deficits moving to the future, is a reality as part of what we've learned through this fiscal update. And I think that this reality of running deeper deficits, as Canada also tackles a housing crunch, seems to be the big takeaway from today. We knew that this federal Liberal government did not want to be in a position where they had to make contributions to new spending at a time when there is a lot of fiscal uncertainty. But the focus on tackling housing is another part of this story as well. And in the face of some of the criticism that the government's received on housing affordability, it is placing housing initiatives center stage today. There's a plan to add housing supply to improve affordability, including an additional $15 billion for low-cost financing for apartment construction. We had talked about that. That had been well telegraphed. And that hopefully is the kind of thing that spurs builders to build more, create more supply. This other figure that had been talked about being confirmed now, $1 billion investment for nonprofit housing providers. So creating more social housing, and also the removal of the goods and services tax from new purpose-built rental housing projects and repurposing some federal lands for housing. So people talked a little bit about the Airbnb effect here with a crackdown on some of that. I know that Laura Dillon-Kane has also been tracking the latest from this government update. And let's check in with her now. She's the Ottawa Bureau Chief for Bloomberg. And so we have a picture here where, yes, the government pushing ahead with some of these housing affordability measures. But, Laura, the deficit picture looking out several years, more sobering than what we would have thought.
That's right. We saw that the government really made an effort to maintain the same deficit for this fiscal year. But what that meant is that they simply stretched out some of their new spending over the next 6 years. So we have $20.8 Canadian billion in new costs over the next 6 years, and there is no plan to return to a balanced budget. So we are going to see an $18.4 billion deficit in 2028-29. At this point, that is the projection. So this was presented as a fiscally responsible budget. The government did attempt to rein in some spending while also promising new spending on housing affordability measures. But what that means is that some of these housing measures aren't going to come into place until 2025. So for people who are feeling the pinch right now, they may not see immediate relief from this fiscal update.
You know, the other thing that a lot of people have talked about, given this deficit environment for Canada, Laura, is the debt to GDP ratio. This comes up because a lot of times, while this Liberal government over the last few years has been keen to spend, there's frequently a reference to how our debt to GDP ratio looks. And obviously, that's something that you're sort of nodding to the credit rating agencies. I think even leading into today, a lot of people said, you know, you don't want to necessarily upset the credit rating agencies. But what we're seeing in this update today is that a slower decline in the debt to GDP ratio is being projected now. It's set to rise, I believe, to 42.7% next fiscal year, before falling to 39.1% by 2028, 2029. But essentially resetting the table on that front as well.
That's right. And Minister Freeland has really described this as her fiscal anchor. This is her preferred measure of assuring Canadians that she is being fiscally responsible. But some economists see this as really not having a fiscal anchor at all. If you keep pushing back the return to whatever you define as a reasonable debt to GDP ratio, then is it really an anchor? You know, we hear her describe medium term. But what is the medium term? Is it being pushed back now to 2028, 29, when we'll see a 39.1% debt to GDP ratio? It's hard to say. That is a big question around this fiscal update, is that sort of continued pushing back of returning that debt to GDP ratio to what the government defines as a reasonable level.
All right, Laura Dillon-Kane joining us as part of our breaking news coverage of this fall economic update. Our thanks to Laura and Jacqueline. Just a couple of other context pieces here. The debt service payments for Canada are forecast to jump to almost 11% of revenue. Bloomberg actually did the calculations on that front. And I think that was one of the concerns with all the spending levels that we've seen in Canada, is what the financing costs of all that debt would ultimately be.
Right.
The government boosting its forecast for borrowing costs. The finance minister did back away from a proposal to wind down the Canada Mortgage Bond Program, which had been floated earlier this year, but there was some opposition from some of the financial markets. Those are just some of the headlines from this update from the federal government.
John, thanks so much for kicking stuff off for us there. That's John Ehrlichman from our BNN Bloomberg team, of course, and Laura Dillon-Kane in Ottawa with Bloomberg. She was in the lockup, able to bring us those breaking details. Let's bring our panel back in here for immediate reaction to what we learned so far. Goldy, Rona, maybe we can start with you. In terms of the deficit, managing to keep it at $40 billion for this fiscal year, but it's not looking like there's improvement down the road. In fact, it's going to be getting worse.
I mean, it's Margaret Thatcher's line. Right. I mean, it's Margaret Thatcher's line that eventually you run out of other people's money. And that's what's happening here. I mean, when you look at the amount of money that they're paying down on just the interest to manage this debt, it's massive. It's $4 billion per month just on interest, just to service the debt. And Canadians are paying that. So everyone was looking for a return to a balanced budget, some type of strong fiscal anchor. We don't see that. We see increasing deficits. And at the end of the day, let's remember there's a political reality here that this government is propped up by a very socialist agenda from the NDP, and we're heading into an election. So we know that we're not going to see less spending in the next year. We're going to see more spending, probably in the next budget. So very concerning, because it's costing us a lot of money to pay off this deficit.
Goldy, what do you think?
Yeah, I think, not to pile on here, but this government has tried to situate this fall economic statement as being, fiscally responsible. I think that's a shell game now. Laura's referred to it as pushing it back. That's exactly what we're seeing. You kind of gerrymandered the numbers to show you on budget in terms of what you've just forecasted. One would hope you would be on budget. You forecasted it 9 months ago, $40 billion deficit. Now you're showing $5 billion more for the deficit from your own forecast made, again, just 9 months ago, where we will be in 27 and 28. And then the number that John referenced, I think, is the one we need to pay attention to, is they want to focus on a debt to GDP ratio, which they're also not meeting, as John reported. We're focused on what the David Dodge model is called. Your borrowing costs shouldn't be more than 10% of your revenues. And we already heard again, by BNN's calculations, they're going to be exceeding 11. And so that should be of concern, because that's what makes program cuts necessary, as opposed to responding to affordability issues that I think we're going to hear more about today.
Yeah, interesting too to be increasing spending, even if it is being stretched out over a longer period of time. In this moment, when we have heard from the Bank of Canada about the concerns when it comes to fueling inflation, but I don't know, is there a benefit then to stretching it out over that period of time where it wouldn't necessarily pique the concerns of the central bank?
Inflation is inflation and math is math. So I agree with the governor of the Bank of Canada. We should be rowing in the same direction. He is right in saying governments, federal and provincial, have been, and a Scotiabank report recently confirmed this, that is responsible for as much as 200 basis points increase in the interest rate. So we're adding fuel to the fire. And we have to be very careful about that because we are facing some significant headwinds on the economy. There's likely a recession here. We know that inflation, yes, it's dropped a little bit last month, but most of that drop, Jacqueline, was on energy. And energy is volatile. It can pop back up anytime, and we'll be right back at it again. And then finally, we've got to be very sensitive to the rising borrowing costs today. But as Rona and others were referencing, John, if we get to a place where United States of America was not only downgraded, but recently removed from stable to negative by an agency, Canada cannot afford that downgrade. When that happens, the interest rates costs go up, and people end up paying the price because that means something has to give.
Yeah, Rona, what do you think of Canada's reputation right now and in this particular environment where we're talking about, potentially, more spending here over the next few years?
I mean, I think it's problematic because we're uncompetitive. I mean, when you look at us compared to the United States, we're uncompetitive. We have, we've just seen recently the government had to go cap in hand with multi-billions of dollars to a foreign company to convince them to set up shop and build batteries in Canada. Wouldn't it be amazing if we had a political and business climate in this country where companies wanted to come and set up here because energy costs were low, because setting up shop here were low, labor costs were lower? We do not have a competitive environment for businesses and corporations. So whatever competitiveness we had, we've lost. And I think that it obviously impacts foreign direct investment. We have uncertainty in the investment community, whether it's around the clean tech issues. This government has said a lot about clean, green jobs, but has not put in place the investment framework so that money flows in and we see those jobs. So we're in an uncompetitive situation. And when I think about just regular Canadians that are out there listening to this, the government needed to send them a message that we've got your back. We know that you're spending too much on groceries, you can't afford your rent, your mortgage payments are coming due, and you're paying too much at the pump. And so it might be a political football right now, but getting rid of the consumer carbon tax would have given, or at least some relief around the consumer carbon tax. And I know it's become a big battle between the Conservatives and the Liberals, but it would have given people some relief in things like home heating bills. And we all see that they need that right now. So I was looking for something really bold. We haven't seen it yet. We'll see, more to come. But I think that comfort for regular Canadians is not in this message. Yeah,
I'm looking for any details, Rona, on the climate side of things and any programming details on that. And I haven't seen them come out yet, though. We all saw the outlooks that possibly there's some details to come. So we'll continue looking for that. What sort of message, Goldy, do you think that this so far sends to the business community? I'm not entirely sure what is targeted, towards the business community at this point. I haven't seen anything on, the CEBA loan side of things, which I know is a concern for more of the small and medium-sized businesses. Anything in particular that you'll be watching out for?
Well, look, you can never take the politics out of politics, so there's at least some political aspect to this, the housing and affordability issue. People don't want to hear the truth. The truth is these are hard issues, and they're going to take time. We have regulatory issues, permitting issues, we have labor issues. We've got lots of things that are holding up the housing situation, but they're going to throw some money at it and hope it works, but I think people are smarter than that. There's a concern here about two things with the government, I will say. Obviously, I've mentioned the spending piece, but the other 2 points that come about is really one of what Rona was just saying. It's the implementation. So there are many policies that were announced in the last budget that were received favorably by the business community and beyond as policies that would enable investment and growth in a more predictable and stable environment. But 9 months later, we're still waiting for the implementation of that. And that's a concern because we have to act with much greater ambition and urgency and speed. I was just in the United States at the APEC, and full-on presentation by the Secretary of Commerce there on why to invest in America, how to get the money, and then presentation by businesses who have done just that from different parts of the world. So we can't have the luxury of waiting. The consequence of the spending and the implementation problem is a credibility problem. We just don't see what needs to get done being done. I think you'll hear more about some of the announcements related to the greening of our economy and the ITCs, as they're called, the investment tax credits. But I just don't see it responding with the same speed and urgency.
And I am seeing some of that now. So just a couple on the decarbonizing of the economy side of things. We have the government saying that the Canada Growth Fund, it will be the main federal entity issuing carbon contracts for difference, which backstop the future price of carbon to provide certainty for businesses. They say the fund will allocate up to $7 billion of its current $15 billion in capital on these agreements. It's already negotiating a number of projects, with a number of project proponents. Now, it also provided a timeline for previously announced clean investment tax credits, those ITCs that Goldy was just mentioning, promising to introduce legislation this fall on tax credits for carbon capture, utilization, and storage, as well as for a clean technology. And Rona, I know that that was something that you were watching out for, updates, clarity on the carbon capture and utilization storage side of things, and with some urgency behind it.
Yeah, this is really important. It's been 2 years since the government talked about having these, finding a way. We can't match the IRA in the U.S., but we can do our best to create a framework, an investment framework that has some certainty around it to attract that type of investment capital into these massive projects that are carbon capture, utilization, and storage. They're really important. If we want to reduce our emissions profile in this country, we need those in the oil sands here in Alberta. But they cost multi-billions of dollars, and we can't expect companies to pay for all of it or governments to pay for all of it. We need investment to flow. So these ITCs are being, there's been a long wait for these, and I hope to see them in the fall. It looks like there's some clarity around that they're coming sometime in the next month or so. That's good news.
Rona, I'm also curious to get your thoughts on this announcement of a new Canadian mortgage charter. It sets out expectations for how financial institutions are supposed to work with Canadians to provide relief and ensure that payments are reasonable for borrowers. This is something that we were hearing about a few months ago already, that the government wanted banks to do this, to be more generous, I suppose, with helping people with figuring out their payments, also fees, looking at where there could be some relief there. What are your thoughts on that?
Well, I mean, I'll just start by saying, look, the core problem is interest rates. And I mean, I can't help but go back to what Goldy said about that Scotiabank report that came out. And if we wouldn't have spent so much and so excessively over the last few years and accumulated this massive deficit, we would actually be about 2% lower in terms of our interest rate. So tough to then say to the banks, like, fix the problem. But banks have a responsibility and an obligation, obviously, to their customers and their clients. And so to lay this out, I think it goes without saying that banks are doing all of this stuff already, contacting clients, making sure that they can do what they can to help people that are in more vulnerable situations. But I think what the government is saying is, look, we're gonna hold you to it, banks. And so far, I think they're doing that anyway, but they're setting out this expectation, which is, I think, a positive thing and probably is already happening.
Rona, we're